Have you ever stopped and really thought about what happens to your money once you deposit it into the bank? I mean, you tap your phone, the numbers go up, and you just trust that your money is there, somewhere, somehow. But have you ever wondered where there actually is? Here's the truth most Americans never think about. The moment you deposit money into your bank doesn't simply store it. They don't just put it in a vault, and they definitely don't let it sit around waiting for you to come back. In fact, your bank is already using your money before you even leave the building. Banks in the United States create new money every single day, not by printing it, not by magic, but through a system that takes your deposits and multiplies them into far more money than you ever put in. And this raises a huge question. If your money is being used to create more money, who is getting the benefit? You or the bank? Think about it. You put in your hard-earned dollars. The bank keeps a tiny portion for safety, and the rest? They lend out, invest, and flip like a business, all while paying you pennies in interest. And yet most people have absolutely no idea this system even exists. That's exactly why this video is so important. Because once you understand how banks actually create money, you'll never look at your account balance the same way again. And hey, if you're new here and you want to understand money the smart way, the simple way, the Explain Varsity way, make sure you hit that subscribe button. We break down complicated financial topics into clear, fun, educational videos every single week. And I promise, you will walk away smarter after each episode. All right, now let's dive into the truth behind what your bank is really doing with your money. Let's start with the basics. When you deposit $1,000 into your bank, they give you a little bit of interest, maybe a few dollars a year. But then they take your money and lend it out at much higher rates. 7% on a car loan, 25% on a credit card, 7% on a mortgage. The difference between what they pay you and what they charge everyone else is their profit. More deposits mean more loans, and more loans mean more profit. Now let's talk about where your money actually sits once you deposit it. Because this part surprises a lot of people. Most Americans imagine their money is locked safely inside a giant bank vault. Thick steel doors, security guards, laser beams, the whole movie scene. But that image is mostly a myth. The reality is far less dramatic and far more shocking. Your bank does not keep your full deposit. In fact, they don't keep anything close to it. Modern US banks follow a system called fractional reserve banking. This system allows banks to keep only a small fraction of deposits on hand, and they loan out the rest. But here's the shocker. Since 2020, the Federal Reserve actually reduced reserve requirements for many banks to 0%, meaning some banks aren't required to hold any of your deposit in physical cash. So that 10% in a vault idea, that's more of a history lesson than a current rule. This is why your money isn't sitting in a drawer waiting for you. It's constantly being lent, invested, moved, and multiplied. Imagine you walk into your bank tomorrow and try to withdraw $50,000 in cash. You might expect the teller to open a vault and hand it over, but in most banks, they simply can't. The average US branch doesn't keep anywhere near that amount of physical cash. They would have to order the money and ask you to come back in a few days. Why? Because banks expect that most people will never withdraw large amounts of cash at the same time. They rely on predictable customer behavior, and that's exactly why the fractional system works, until too many people want cash at once. This is how every major bank in the United States is able to lend aggressively. They only hold enough cash for normal daily withdrawals. Everything else is circulating through loans, mortgages, credit cards, and business lending, not sitting in a vault. And here's the biggest myth to clear up. Your bank does not have a labeled box with your name on it filled with your dollars. The digital number in your account is a promise, not a pile of cash waiting for you. Fractional reserve banking allows banks to use your deposit almost immediately while still showing your full balance on your screen. This setup is one of the most important and most misunderstood parts of the US financial system. Understanding it changes how you see money forever. Here's where things get interesting. Let's say you deposit $10,000 into your account. The bank keeps $1,000 as reserves and loans out the remaining $9,000. Now look at what just happened. You still see $10,000 in your account. The borrower now has $9,000 in cash, and the banking system suddenly shows $19,000 created from your original deposit. But it doesn't stop there. The borrower spends that $9,000. It gets deposited into another bank. That bank keeps 10% and lends out the rest again. And this cycle repeats over and over. From your single $10,000 deposit, the US banking system can create over $90,000 in new money. No printing, no mint, just lending. This is how the US money supply grows. Now, here's a question. Do deposits create loans, or do loans create deposits? The real answer is both. In modern banking, large US banks often create a loan first and worry about the reserves later. If they need additional reserves, they simply borrow them from another bank or from the Federal Reserve. reserve. This is why the old idea that banks lend only what they receive is no longer fully accurate. If banks can create money through lending, why don't they just lend forever? Two major limits stop them. The first is profitability. Banks have to ask, will this borrower pay the loan back? What's their credit score? What are the economic risks? If the borrower defaults, the bank loses money, so they lend only when it's profitable. The second limit is capital requirements. This is the real speed limit on bank lending. Capital is the bank's own money. Regulators require banks to hold a certain amount of capital for every loan they make. This acts like a financial seatbelt and helps prevent failures like what happened in the 2008 crisis. Now let's answer the big question. Are you safe? If your bank fails, what happens to your money? In the United States, your deposits are protected by the FDIC, the Federal Deposit Insurance Corporation. FDIC insurance covers up to $250,000 per depositor, per bank. If your bank collapses, the US government guarantees your insured deposits. Here's your final recap. Banks make their profit from the spread, the difference between the interest they pay you on deposits and the higher interest they charge borrowers. Through fractional reserve banking, they're able to lend out most of the money you deposit, keeping only a small fraction in reserve. This process doesn't just move money around, it multiplies it, fueling growth across the entire economy. Loans don't simply follow deposits. In many cases, loans themselves create new deposits, expanding the money supply. Of course, banks can't lend without limits. Capital requirements and regulations act as guardrails to keep the system stable. And for everyday customers, protections like FDIC insurance mean your deposits are safe even if a bank fails. So now you understand the hidden engine behind modern finance. Banks don't just store money, they create it. Every loan, every deposit, every transaction is part of a cycle that shapes the economy we live in. You've just learned how banks actually create money, a concept that's simple on the surface, but powerful once you see the mechanics. This is Explain Varsity. Learn money the smart way. And if you found this eye-opening, don't forget to like, subscribe, and share, because understanding money is the first step to mastering it.